most successful fights will secure very little. As Pope John Paul II, in my view, one of the most extraordinary champions of democracy on this continent or any other, once said, "Do not be afraid." We shouldn't be afraid of our people, even when they express views that disagree with their leadership. Thank you all. Good luck to all of you. God bless you.
All right, we're listening to J.D. Vance, the U.S. Vice President, addressing the Munich Defense Conference and really going directly at Germany there in terms of their firewall to keep out the AfD from power. I'm Matt Miller here in New York alongside Katie Greifeld and Sonali Basak. This is Bloomberg Open Interest, and we are joined right now by Bloomberg's Oliver Crook. He is at the Munich Security Conference, and Bloomberg's surveillance co-host Anne-Marie Hordern joins us as well, somewhere, I guess. I don't know exactly where she is, but in any case, I'm going to go to Oliver first. Taking direct aim at Germany there, taking direct aim at a firewall that probably, people in other democracies don't exactly understand. J.D. Vance saying democracies have to listen to the will of the people. What do you make of it, Oliver?
Can someone...
No. We don't have Oliver. I do see Anne-Marie sauntering on set.
Well, we'll get there.
We'll get there eventually. You know, absolutely fascinating turn of events here because you had Elon Musk supporting the Alternative for Deutschland, the far-right party, which the mainstream German parties have been trying very hard to keep out of power.
So there's on-the-ground tension as well as international
Well, and especially
tension.
now because an Afghan man allegedly drove a car into a group of labor protesters at the Munich Security Conference. So definitely tension on the ground there. Oliver Crook, I'm being told we have you now. What do you make of J.D. Vance's speech? How's that going to be received by the Bundestag?
I mean, listen, it's going to be received very poorly from this Bundestag, but as we know, we have an election coming up in the next week, and the next Bundestag is going to be constituted by 1/5, 20%, by the AfD, the Alternative for Deutschland, which is a state of affairs you've never really had in Germany since the end of the Second World War. And that is sort of precisely what was at the center of J.D. Vance's speech here. We're at the Munich Security Conference. This is really a conference about defense. We really thought it was all going to be about Ukraine. I mean, this was part of the speculation. He really spent very little time talking about Ukraine and physical defense. He really went on a political manifesto about basically the virtues of free speech and really promoting not just the America First attitude, but the sort of values that drive that, and saying that really you need more of that here in Europe. He was talking about censorship on social media. He was really sort of lambasting a lot of these sort of mainstream political parties within not just Germany, within the United Kingdom. He was referring to the fact that the Europeans were very concerned about the Romanian election where there were a lot of irregularities, and they were calling for an investigation there. He says that basically that amounts to the Europeans wanting to cancel election. This was a very explosive speech here that he gave, and it is one that is not going to be particularly well received by a lot of the sort of mainstream political parties here. And as he mentioned, the AfD does not have any room here. This is all part of the sort of agenda that he's been putting forward and is going to be sort of come down very mixed, particularly a week ahead of this German election.
Absolutely. Harsh words for Germany. Like you were saying, that America First attitude really on display. Let's bring in Anne-Marie Hordern right now, because as Oliver was just telling us, really little reference to Ukraine, obviously, arguably the biggest international story right now. What do you make of that fact?
Well, he's going into Europe and he's rejecting European establishment, and he's saying it to their face, basically saying as another member of Western democracy and as friends, we should be honest with each other. This is what J.D. Vance is trying to explain to this audience when he says also there's a new sheriff in town. Things are not going to be the same way they were over the past 4 years. A source messaged me during that speech and said J.D. Vance is saying, you want to talk about us, because remember what was the prelude to J.D. Vance was also tough talk from Ursula von der Leyen about what President Trump is trying to do in terms of tariffs and a reciprocation of tariffs and trying to realign the global system. He is saying, you want to talk about us, let's talk about you. And as we're going through that, it's not going to be the same as it's always been. So this was an absolute rejection of the European establishment from the United States. And for J.D. Vance, this was almost set to happen, given what you heard from him overnight in the Wall Street Journal. This is what he had to say. He was talking about the fact that when it comes to Europe, they are shutting out, in his words, free speech from a lot of populist parties. And he thinks in the end, and he said this during his speech, if you're running away from your own voters, America will not be there to pick up the pieces and help you.
Yeah, I think that's a really important aspect of this. You know, Anne-Marie was just citing, Ali, about how the message here is worry about what's happening in your own house. But going back to the Ukraine point as well, for him not to be mentioning what is going on, particularly as I know we have an interview with Ukraine's Volodymyr Zelenskiy coming up very shortly here, what does this mean? Does this signal that the decisions are being made at the hands of President Trump alone?
I'm sorry, I think that's for me. Yeah, I think that is the fear here in Europe, is that basically this is a new American foreign policy. This has nothing to do with the multilateralism of the past. This is unilateralism. And guess what? The train is loaded and it's leaving the station, and it feels like the Europeans are watching it from the station sort of depart. More has happened probably on this issue of Ukraine over the last couple of days than probably over the last year. I mean, the fact that, Trump spoke to Putin, that has raised a huge amount of eyebrows here. A lot of people were shocked about that. But I've talked to people here who say, listen, this is not really a shock. This is exactly what the president said that he would do. He wants to make things move quickly. He doesn't really care about the sort of principles of it. He says, listen, we need to have a much more pragmatic approach on all of this. But I just want to reiterate one point here. What J.D. Vance was saying, you thought that this was all going to be about Ukraine. This was going to be about the sort of the global order. He said that the biggest threat to Europe, it is not Russia, it is not China, it is the threat from within. This is the message that the vice president of the United States brought here in Europe, basically saying that the establishment politics are the biggest threat to European safety. That is an explosive statement to make among these people.
Anne-Marie, what's your take on what Donald Trump gets out of a deal here? What are we expecting to hear from President Zelensky when Francine Lacroix sits down with him in about an hour's time?
I'm sure Zelensky, and I spoke to him over the summer, he's going to want to make sure that Ukraine is at the table. And when it comes to this peace agreement, I think it was very telling that Trump obviously recognizes Russia as a great power and spoke to Putin first and then got on the phone with Zelensky. So I think that's one thing Zelensky is going to want to stress. He's obviously also going to want to talk about the fact that he is ready to work with this administration. Scott Bessent, the new Treasury Secretary, was just in Kyiv. They were working on potentially talks about critical minerals. So Zelensky is going to want to play up all that Ukraine is willing to do, but really want to emphasize that he needs to have a seat at the table when they're talking about some sort of peace agreement between Russia and Ukraine.
And our latest reporting shows that Zelensky says that he's ready to engage with the U.S.-led peace initiative, willingness to talk with Russia if certain circumstances do arise. Oliver, I'll go back to you, given that you're on the ground, you're in Munich, ahead of this interview that we're awaiting with Zelensky. Bring us more into the room and what the conversations sound like.
Yeah, I mean, listen, the part of the reality of the situation is that Zelensky needs to put a brave face on basically anything the United States says. Even if he's not happy with it, there is no choice. He talked about it earlier this week, that basically security guarantees for Ukraine that do not include the United States are basically worthless. And that is basically saying that the Europeans alone cannot be able to secure Ukrainian safety in the future, that you really need the United States. So basically, no matter what, Zelensky needs to be there and saying positive things about the Trump initiative, even though he may not be completely thrilled about it. We talk about these we talk about the sort of the Europeans here trying to get a seat at the table. The reality of the situation is they can only ask. And the fact of the matter is, what we just heard from J.D. Vance, this is a U.S. delegation that is not coming here for European input on a peace plan. They're coming here to talk, not to listen.
Anne-Marie, what does this mean? And this is, of course, a lot of what this comes down to as well. The direction of NATO moving forward. Of course, there's a lot of fracturing here between the U.S. administration's posturing, the way they have been dealing with Ukraine and Russia so far, and the future of the treaty.
Well, I would love to pick up on that last point Oliver brought up, which is that Europe wants a seat at the table. From a Trump administration point of view, Europe has forfeited their seat at the table.
100%.
They have been talking about for decades. I mean, yesterday, Trump talked about that he wants to bring Russia back to the G7, make it back to the G8. And in that time frame, when Russia was kicked out of the G8 because of their legal annexation of Crimea. Germany was still willing to do another deal of Nord Stream 2. And Trump has complained about this for decades. Why are we protecting Europe when they're still willing to basically send all their cash and build the manufacturing base of Europe, of Germany, by buying this cheap Russian fuel? And at the same time, Trump has also talked to them about raising their defense spending, something that we also saw the Biden administration talk to the Europeans about. So when Europe is saying we want a seat at the table, this Trump administration is going to see you forfeited that right years ago.
I mean, especially considering the fact that they are financing Moscow, as you point out, Anne-Marie, at the same time as they're trying to send, less money to Kiev. Angela Merkel was pushing for Nord Stream 2 against Trump in his first term after the annexation of Crimea. Oliver, how do the Europeans address that? I mean, I know that they're not sending 16 billion euros a month to Moscow anymore, but it's still 1 billion euros a month to buy fuel. How do they respond to that? They've made so many mistakes, especially in Germany, where they decided to cut off their nuclear power source and boost coal into the crisis.
I mean, and this is part of the criticism that you hear from the AfD, the Alternative for Deutschland, the far right, who has gained so much popularity in the last few years. They basically point to all of these policies and basically the fact that a lot of these sort of mainstream parties have been ineffective and have made some decisions that have been very, very dubious. You point to the nuclear shutdown of the power plants. That is one of the main things that the AfD talks about. They literally shut down the nuclear power plants in the middle of the energy crisis. And again, these are all going to the point of these parties that J.D. Vance is saying, you need to pull into the fray. You cannot continue to have this firewall. You need to start listening to the population and these criticisms that they're giving. And again, what I keep going back to is I remember a conversation in the first Trump administration when Trump was speaking at the UN. He was basically trashing the Germans for not spending enough in NATO, for buying all this Russian gas. They cut to them. You see them rolling their eyes, and it's a completely different scenario now for Trump Volume 2. Everybody is seeing things very differently. Of course, those comments were very vindicated for Donald Trump. But again, to your point, Matt, there is a sort of problem here in Europe, and it's not just with Germany. It is also with the Europeans. They're very high on values. They're very low on pragmatism, and that is beginning to hurt them in a major way.
Ollie, you and Anne-Marie have both brought up the idea here of energy and the issues that have been brought forth of the reliance of Europe on Russian energy. In a separate interview this morning, Treasury Secretary Scott Bessent told Fox Business that he would consider escalating sanctions on Russian energy if asked to do so by the president. But of course, we have seen the president trying to negotiate, for the lack of better words, with Russia himself. How likely is that scenario, Anne-Marie, and what does it mean for global oil prices? Frankly, there seems to be a lot of uncertainty on what that could mean for prices for consumers moving forward, even in the U.S.
Well, I would just say from the base case is that sanctions on Russia haven't exactly worked in terms of pulling back Putin from this war. He is still making tons of money selling fossil fuels. Sanctions just created new markets for Moscow. Two, I would say Trump is probably going to go back to a maximalist approach in the sense that all options are on the table. And J.D. Vance, the vice president, talked about that in this Wall Street Journal speech, Wall Street Journal interview before his speech at the Munich Security Conference. So I think Trump will use both levers depending on where the peace negotiations go, meaning he can use a lever of we are willing to ratchet up sanctions. We are willing to even potentially put more weapons on the ground in Ukraine and support Zelenskiy and Kyiv if Putin is not coming to the negotiating table in a fair way.
And Ollie, I want to finish with you specifically on Germany, because you think back to the speech we just heard from J.D. Vance. Parts of it weighted into the German election, which, of course, as you know, is just over a week away. Walk us through the issues there and how some of the things that we're discussing right now might appear at the ballot box.
Yeah, I mean, listen, there's so many firsts in this German election, not least of which the sort of appearance of the Alternative for Deutschland, the far-right party, being basically a fifth of the vote. That has not happened since the end of the Second World War. But again, there's also the feature of Americans being very interested in German politics and very vocal about it. We've had Elon Musk wading in for months into the German election. This has really upset a number of people here. But of course, the AfD has profited from this and basically used Elon Musk as their mascot, not just on the sort of cultural values, but also having a very successful businessman, giving some credibility to their economic policies, which are sort of libertarian in style, right? And this is going to all sort of come to a head. And I have to say that in this sort of German election, the polls have remained very steady. You talk to people in Germany, you talk to individuals, there is a huge proportion of people that say, listen, I do not know who I'm going to vote for. That is not, I don't think, a general arrangement in Germany. People tend to be fairly loyal to their parties. So when we look at that ballot box and we look at that vote on February 23rd, I would not be surprised if it came out with, some surprises. We don't really know what is going to happen. But at the end of the day, all of this speech by J.D. Vance, the Trump administration, what we keep hearing is it's the wake-up call for Europe. The question is, with these mainstream politicians, are they going to hear that wake-up call and be able to get things done, or they continue to be sort of uncompromising and have this sort of stagnation economically and politically that we've seen in Germany over the last few years?
Yeah, Germany absolutely in play. Bloomberg's Oliver Crook, the best to cover it. Thanks so much for joining us, Oliver, and Anne-Marie Hordern as well, with your experience covering OPEC, covering Russia, and covering politics. Great to have you on this program. Later this hour, don't miss our panel at the Munich Security Conference. Ukraine's president and U.S. senators, including Lindsey Graham and John Cornyn, are going to sit down with Francine Lacroix. Katie?
Meanwhile, let's get a check on these markets. Just less than 20 minutes to go until the bells ring. You can see a little bit of a down day in markets right now. We had a big rally to finish out the Thursday session, but if you're looking for a reaction to those retail sales that we got at 8:30 a.m., that big miss that we saw for the January figures, look at the bond market. You can see 10-year yields currently down about 6 basis points. That's where the reaction is, not as much in the futures market, where, of course, equity futures have been under pressure all morning, Sonali.
And it's amazing. A lot of that bid in the bond market came, of course, on the heels of U.S. retail sales dropping broadly in January, a month that was, of course, impacted by severe winter weather, deadly wildfires as well. We're going to dig into the data with Bloomberg International Economics and Policy Editor Michael McKee. You have a move this week from where we saw at the end of Wednesday at the 10-year yield, of course, spiking on the heels of CPI. We're down by more than 15 basis points now, and the bid coming back into the short and longer end of the curve, partially because of this weaker data. Is any of it justified?
Well, we're having an Emily Latella moment, as I like to say, with the bond market. Never mind. They got all concerned about the CPI, and then the last 2 days we've gotten good news on what is likely to happen with the PCE. And at the same time, you see consumer spending weaken. Now, this is a really bad consumer spending retail sales report that is probably influenced, as you mentioned, by the fires and the bad weather. So we'll have to see what happens with February spending. But 9 of the 13 categories were down. It's the lowest retail sales number in 22 months. There's nothing really good about this to say, except that consumers pulled back some. Now, I put import prices and international airfares on here because international airfares out of this import price release is the category that people pull out of this one release to stick into that PCE calculation. And after CPI, PPI, and now this drop in international airfares, it looks like we're going to have a low PCE, which will reassure the Fed about the direction of inflation. But they were not going to be cutting rates anyway because the economy was fairly strong. If the economy and consumers are falling off, then that brings all that back into play. Might be too early, given the uncertainties about what the administration is going to do, to start talking about a change in bond market philosophy, but we're kind of there.
All right, Bloomberg's Mike McKee, thanks very much for that. Emily Latella, ladies, is a reference to a character made famous by Gilda Radner.
I really appreciate that you knew
you.
that I wouldn't know what he was talking about.
Yeah.
I just want to let it go.
Listen,
but
A reference, it did go like this, so I appreciate that.
I understand, but it's especially relevant today because Saturday Night Live will be ringing the bell at the New York Stock Exchange.
50 years, baby.
50 years. All right, Allspring Global Investments Senior Portfolio Manager Margaret Patel joins us to talk stocks. And I want to get back to stocks, Margie, because we've been so focused on geopolitics. To be fair, it does have some effect on the bond market, although it's declining. And we do see some big single stock stories today. Intel has had a killer week, the best since 1982.
There we go.
And we heard J.D. Vance say that he wants to bring, high-end chip production, high-end AI hardware production back into the U.S. That seems to be on everybody's bingo card. What do you make of the gains in chip makers and Intel especially?
Well, Intel, I think, is a special case where they may be able to have a partnership where they can utilize their manufacturing production in a more efficient way. So we'll have to see on that what the outcome is. That's a long-term thing with lots of things to be worked out. But I think really what you're seeing is people are hypersensitive to each little data point that's released, today's number, yesterday's number. And I think it says there's still this overlay of uncertainty about the effect of tariffs and new administration. So we don't have a clear picture yet. But I think after we sort ourselves out of this first quarter, I expect the market will be back on the upswing for the rest of the year.
Whether or not it's back on the upswing, one thing I have a question about is what role the bond market plays. There are a lot of estimates out there with a lot of folks thinking that you could see 3 rate cuts still well into next year, and others believing that you might still see hikes. How vulnerable is the stock market to that kind of movement that's anticipated in the bond market? The spread is still so wide, Margie.
Well, you've seen this whole cycle, the whole Fed tightening cycle, the beginning of easing. Really, the equity market has been more or less impervious to that because companies have structured their balance sheets, their profitability, their profit margins have been much more important for stock price than what the Fed is doing. Why? Because companies have not been dependent on borrowing short-term at very high rates. So this is a cycle where the Fed has had, frankly, very little influence. And I think 10 years probably just in a trading range, 4 to 5%. And I think that you've seen that inflation is looking more stubborn. So I'm not really looking for the Fed to cut rates at all this year.
Yeah, Margie, we've heard that plenty of times over the past couple weeks, that the Fed really not the driver here. You should be paying attention to earnings. And I actually want to go back to the chip makers, and I want to go specifically to NVIDIA. NVIDIA has been in a really interesting spot the past couple weeks. Bloomberg had a great story on the terminal a couple days ago about how after DeepSeek, after that revelation that we had, that maybe NVIDIA isn't bulletproof anymore. And you've certainly seen the volatility come through in the shares. What's your current thinking there on NVIDIA, but also the chip space in general, when you think about maybe those billions and billions of dollars we're spending on the AI build out, maybe we didn't need to?
Well, I think the artificial intelligence boom is real. I think that'll continue, and especially chip makers that are part of that expansive in demand. So I think that's still intact. I think basically everybody owned NVIDIA, everybody loved NVIDIA, and it clearly was had very little room to move until it has more good news on earnings. So I think it was natural that we'd seen a little leveling out in the stock. But I still think it's going to be a leader this year simply because of its dominant position in artificial intelligence.
When we get, moments like this in Munich, or really like yesterday in Washington, D.C., and we don't see a bond market reaction anymore, does the geopol kind of lose its value to you, or do you focus on it at all anymore as we continue to hear President Trump cry tariff? Uh-oh.
Seems like we might have lost Margie.
I shouldn't have shifted away from technology there.
Yeah, it was a good question, though, because we were talking about this in our morning meeting, that you think about, of course, what we saw over the weekend, the suggestion that maybe treasuries, maybe we have less of them than expected. And then the tariff threats yesterday didn't see much of a market reaction. It seems like the shock value has gone down a bit.
That was supposed to be the big day. Didn't he say? He tweeted, this is the big day.
Say today's the big day.
And then what did we get?
It did end up being a big day in the markets. The S&P 500 rose about 1%. I don't think that was
But we got no real tariff announcements, right?
One thing that's hard about it is the idea of waiting till April to see any of it potentially maybe sort of kind of take effect, is it adds an uncertainty overhang for months ahead.
Do they really need to study? Do they really need until April? I mean, what was Project 2025 all about?
Yeah, no.
Didn't they study during the campaign?
That went a little deeper than
How much studying do you need to do?
These are all big questions.
Check it out. This, by the way, this is something Katie, Sonali, and I were looking at again today.
It's an art piece.
This is, every little blue line there represents a 10 basis point move or more in a one-day session on the 10-year yield.
I would love for you to get this commission for me to hang on my wall at home.
That's an insane amount of volatility in the bond market.
There's a lot of blue on that chart. We will sort of go over all these big questions in the break. We have much more markets coverage coming up next. This is Bloomberg. All right, we are minutes away from the opening bell. Let's get a look at the movers ahead of that with Bloomberg's Jess Menton. And Jess Menton, surprise, people are betting.
They are. So DraftKings has to point this out ahead of the opening bell. So you look at this, it's up more than 5%, but in context, it's still down about 35% from its all-time high back in March of 2021. But what you saw here, it actually boosted its annual revenue outlook here. And so that's what's really helping that stock. But of course, I have to point out, it still is going to face a suit after canceling a bettor's $150,000 bet. So actually, they were trying to say that it was more house rules here. But that's something that's been in focus in the latest week, shows what was going to happen with that. But still, if you're looking at that yearly forecasting revenue around $6 billion to $6.5 billion, so still above those consensus estimates.
That's incredible.
Annually.
You have MGM rising more than 17% yesterday. Wynn has also been performing quite well.
By the way, you keep a pretty close
eye on betting
watch over these gambling stocks. I've noticed
nobody
that.
over here is gambling at all. I don't know what you're talking about.
That we know of.
I don't have that kind of risk appetite.
Nobody else is traveling either. Airbnb also an interesting mover this morning.
Another good look into the consumer. So they saw a strong holiday demand, but they do have a key metric, especially when you're looking at what that means for the current quarter. So they have metrics as far as when you're looking at cross-border travel improving in Asia, specifically with China. So that ties into the pandemic. But you are seeing that stock up close to 13% ahead of the opening bell.
I am so surprised that Tesla is down 12% year to date.
Well, it's given up a lot of those gains, and you're starting to see that in the options market as well. So it's also
The
trading
CEO
about
is co-vice president of the United States of America, or co-president.
Well, its earnings, if you're looking at projected earnings, 119 times projected earnings, and the Mag 7 cohort is actually around 30. So just keep a close eye on that right now.
All right, Jess Menton.
Good to have you this morning. Of course, guys, we're still in the middle of
No, don't say it.
earnings
It
season.
never ends.
We are very
Bonus
much
season.
still there, but it's nice to get a look at the consumer in addition to the data. But coming up, the opening bell. Plus, we're going to take you to our interview with Ukrainian President Volodymyr Zelenskiy live from the Munich Security Conference. Stick with us for all of that ahead. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are doing nothing, but after what really was a big day yesterday in markets. I mean, we closed at, I think, 6,115 on the S&P 500 after not really getting much of anything at all on tariffs from President Trump. NASDAQ futures are just as unchanged. Russell 2000 futures up about 0.5%. The opening bell on the New York Stock Exchange, Karman Space and Defense, because they had an IPO. Congratulations on that. But I think far more interesting is Saturday Night Live, along with a range of cast members and apparently some of their children as well, ringing the bell for their 50th anniversary. We were have been thinking about Gilda Radner today. Wish she were here. In terms of stocks, she would have made so much money. Stocks are up, the S&P, like 6,000% since 1974.
There you go.
And let's take a look, Katie, at what they're doing in this moment in the first 40 seconds of trading.
We've also been talking a lot about Chris Farley, clearly SNL on the brain right now, and that's maybe more exciting to talk about because not too much is going on in the market right now. This entire week has been a bit of a head scratcher when it comes to how to trade this economic data. Hot CPI, hot PPI, a huge rally yesterday. Now we got very, very weak retail sales data, and you can see the S&P 500 rallying a little bit in response, up about 0.1%. Same story if you take a look at the NASDAQ 100 and your big tech names, higher by about 0.1%. The small caps have been particularly interesting this week. Of course, we've had this big bond market rally develop just in the last 2 days, and that's being expressed in the Russell 2000 as well. Currently higher by about 0.4%, just about a minute and a half into trading. But let's get specific here and let's talk about Intel. We were talking about what a huge week it's having, its best week since 1982, on reports that the U.S. government is possibly getting involved with a plan that would involve both Intel and TSMC. We also heard from J.D. Vance earlier in the week talking about how we're going to be producing these American-made chips. All of that is adding up to a 28% gain for Intel this week, Sonali.
Yeah, pretty significant story and a lot of questions still on what's ahead. But a nice run this week. Not so nice of a run here for Moderna today, down 5% as the market opens. They reported a quarterly loss due to waning vaccine sales. The company is struggling to grow its business with plans of more than $1 billion in cost cuts this year. They've been posting a string of quarterly losses, really, Matt.
All right, yeah, we're paying attention to mRNA today as well as DraftKings. Those earnings beat expectations because probably of the betting that you've been doing, and it raised its sales guidance, overcoming concerns about the sports betting market. We could see those concerns come back, right? We were talking with Vlad Tenev yesterday.
That's exactly
from Robinhood.
where I was going to go, because you think about the events contract ambitions that they have. The Super Bowl for 2025 didn't exactly work out for Robinhood, but we know they have big plans. You have to wonder whether that's going to sort of take some territory away from DraftKings.
You know that I have so many feelings about this, right? Because
Tell
this
us
is a
about
state-by-state market. In fact, I'm so close to New Jersey in my house that if I'm betting in certain parts of my house, I can't bet.
Wow.
So
interesting.
But if you have the CFTC saying, whatever, this is all just an event contract and we're fine with it now, then does the moat go away for a place like DraftKings? And then a place like Robinhood could work with a place like Kalshi, and then all of a sudden you can bet in different places.
Could be a totally different landscape. And this is a landscape that has changed a lot in the past couple of years.
Well, and for Sonali, it's worlds colliding, right?
That's true.
With her crypto coverage and markets coverage and NFL sports betting problem. Let's, though, get back to the broader market picture. We still have Bloomberg's Jess Menton with us here on set, and we can talk about some of the individual movers, but I want to get just a check on how the markets have done under President Trump. He had so much in store for us in terms of tax cuts and tariffs and deportations and deregulation. So far, there's just been a lot of talk about tariffs without really doing much.
Well, on China.
Oh, okay.
We got China.
So what have we seen in terms of the Trump effect, the Trump trade? So far, 3 weeks into the presidency?
Well, I like to look at positioning specifically because that can tell you kind of what systematically and then discretionary funds and how they're positioning. So still it's hovering towards those records that we would have seen in a bit stretched there. But when you don't have actual policy going through, tariffs don't necessarily need Congress to approve a lot of that stuff. But then there's other things on the tax front that a lot of portfolio managers specifically would have to position on. So they really have to wait till things actually take place before they start changing that. So it's interesting yesterday because you saw the S&P 500 trading just below its all-time high. It actually hit that earlier in January. But then I was like to look at what the riskiest corners of the market are doing. So if you look at what's happening with Goldman Sachs' basket of most shorted stocks, that was actually up more than 3% yesterday. And then also they have a separate basket that looks at non-profitable tech. So those are younger companies that need more funding, not necessarily the big tech type names like when you think about NVIDIA or Apple, something like that. But that also was up over 5% yesterday. So that's telling you that the riskiest parts of the market were rallying yesterday on the back of basically not getting a ton of news there about the timeline of tariffs.
And just even more pain for those short sellers. But Matt, you make an interesting point about where we are on the Trump trade, and something that I've been thinking about. This is actually a theory that I stole from Stephanie Flanders of Bloomberg News, that it's that he didn't pursue tax cuts first. He went with the sort of market unfriendly policies.
I would totally agree with that.
And tariffs. If he had pursued tax cuts first, it's possible we would be having an entirely different market conversation right now.
Well, but he can't do tax cuts with an executive order.
Right.
Right? So he went after the things that he could achieve with just the stroke of a Sharpie.
How many times have you heard tax cuts? In fact, you've seen some parts like the carried interest tax be disputed. So you've seen kind of the opposite here. Just the other thing I'm kind of fascinated by here is the push-pull with the Magnificent Seven, because if you look at performance this year, it's pretty meager. It's only up as a group less than 2%, 1.2%.
Pedestrian,
and it's really Tesla and NVIDIA still driving that. And NVIDIA, of course, we know has been pretty sluggish all year, too. Is that going to be what investors are looking at to drive stock market performance this year still?
Well, Goldman Sachs, David Kostin, they like to put out whenever they're analyzing the transcript scenario analysis. And so far, when you've seen the mentions here, AI is still in the top 3, but it's more tariffs are dominated on the calls right now. And then after that, it's the U.S. dollar, just given that it's been so strong since the end of September, but we have seen it pull back, come down from some of these technical levels of late. But that's going to be an interesting thing that Bloomberg Intelligence is especially focused on moving forward. But what's interesting just from earnings in general, when you're thinking about the Magnificent Seven, of course, the base over base effects, we have seen some of those growth estimates slow here, but tech in general is still carrying those estimates, and especially when you're thinking about other sectors like communication services, obviously Mag 7 companies housed in that technology, and then of course discretionary, because that's where Amazon and Tesla are housed as well.
Yeah, it's a good reminder that when we talk about the Magnificent Seven at the sector level, we're not necessarily just talking about tech, but let's talk about the earnings picture overall, because there was some really interesting data out from Bloomberg Intelligence earlier this week, taking a look at the companies that actually beat their estimates, not necessarily getting rewarded in the stock market like you might expect.
That's right. So you can look on the dashboard here. So if you're looking at just for companies backward looking, though, for the fourth quarter that are beating both on EPS and sales estimates, right now the average of them being actually rewarded here, it's a lot less than what you would expect them to see. But what's interesting is it's more companies, what they say about guidance. And of course, quarterly guidance, if you're looking at that, only about 25% of companies give quarterly guidance, and a little bit around, maybe around 60% of companies give out annual guidance. And it's mostly tech as well as consumer discretionary. So when you're looking at that, it's actually companies that are beating on EPS and sales for guidance specifically. They're being rewarded by the second most. It's actually over 6% right now within a day of reporting relative to the S&P 500. So that's the second best since basically the data is being compiled since early 2020 there. But if you're looking more backward looking on what they're beating for the fourth quarter, not getting rewarded as much handedly there. So really keeping an eye on what's happening with the guidance right now.
Now, let's go into some of the specific earnings as well, because I think I'm pretty fascinated by some of the movers under the surface. Roku, for example, today we're keeping an eye on. When we're thinking about TV streaming, it's interesting to see them come back this way.
It's interesting, too, because that stock's down actually 80% from its all-time high in July of 2021. And I feel like when we talk a lot about these size and scope, some of these sort of pandemic-type, darling-type shares here, but actually that revenue growth is what was easing some of the slowdown fears. So Bloomberg Intelligence's Geetha Raghunathan was talking about how some of the concerns there when you're looking at what's happening with revenue, that was quelling the concerns about an ad slowdown. So that's what she was looking at too. And if you're just looking at the commentary right now, what they're talking about with those advertising activities, specifically for the fourth quarter, those were faster than expected.
And I do want to point out Moderna as well. Moderna actually halted for volatility right now, had been down pretty mightily after reporting a quarterly loss due to waning vaccine sales, a canceled manufacturing contract, but right now it had turned positive. Now it's halted for volatility. We're going to continue to monitor that one.
Yeah, no, it's incredible. You're seeing a lot of intraday stock volatility more than the index level volatility. In addition to earnings, 13Fs are also flowing in. I'm pretty amused by what we've seen out of not a hedge fund's 13F, but NVIDIA's.
Mm-hmm. Right, and specifically SoundHound. So I know this is one of Tom Keen's favorites that he always likes to talk about when I bring it up.
First of all, it's a great name, SoundHound.
It is.
And secondly, let's just repeat that, because when we talk about 13Fs, traditionally we're talking about hedge funds.
They're also
right?
backward looking, by the way, right?
Okay.
They are.
But just so that viewers understand, we are talking about NVIDIA's 13F right now.
Yes.
Jensen Huang's hedge fund.
Yes.
And especially because this is the day, so after the bell, we're going to get more information specifically from hedge funds, but we're starting to get some news out here, and specifically because we don't get it until 45 days once the next quarter has started. So this is for the fourth quarter, but specifically if you're looking at what NVIDIA is talking about in its 13F filings, it's actually disclosed that it added stakes to 2 other firms, but actually it sold off 3 of those, and SoundHound is one of them. So if you look at SoundHound, SOUN is the ticker symbol, down over 30% on pace for its worst day since June of 2022. Of course, SoundHound is tied to the AI type of themes that we talk about here. So another one was NanoX that NVIDIA revealed that it had sold stakes in, as well as server robotics.
Jess, great to have you.
Nebius also, by the way.
What is it?
Nebius.
Nebius.
Also on the rise with a little appearance there.
Not nebulous.
Jensen's hedge fund, as you
Jensen's
said.
hedge fund, yeah.
Jess Metten, thank you very much for that. Jess Metten giving us an update on what's going on in the stock market today. Looking at the bigger picture, I was sort of typing away here to figure out.
Yeah, you looked busy.
How much would you guess the S&P 500 has appreciated since the first episode of Saturday Night Live, which aired on October 11th, 1975. And I told you it was about 6,000% already in terms of the price appreciation. What about
in total return?
Total return.
Shoot, I have no idea. A gazillion?
26,638%.
That's not
according
too bad.
to the Bloomberg comp function.
I would
What
like
does that say about SNL?
What does that say about?
You know, do you guys watch? Do you watch SNL?
I do.
You do.
I do.
I also do, yeah.
So, okay, people are still watching it, which I think is great. I loved it when I was a kid. You mentioned Chris Farley, Gilda Radner. Obviously, I love Chevy Chase and Dan Aykroyd.
Guess it's refreshing that some things stay the same.
Yeah.
Yeah. Very good. Okay.
All right.
Ringing the bell there at the NASDAQ market site today. Coming up, Wall Street bets on high rollers after big MGM, the big MGM earnings win, to which Sonali may or may not have contributed. Details in Top Calls. This is Bloomberg. All right, we heard earlier this hour from the United States Vice President J.D. Vance talking at the Munich Security Conference. We are now talking to Ukrainian President Volodymyr Zelenskiy there. Francine Lacroix is moderating a panel that includes U.S. senators. Let's listen in.
Сьогодні ми не говоримо про будь-яку мирну угоду. Хоча, скажу вам відверто від себе, на жаль, війна довга, яку розв'язав Путін, і дійсно ця...
So, Zelensky there, speaking Ukrainian. We'll get you a translation of that when we can, but just wanted to give you a heads up that that's there, and we will continue to bring you headlines, of course, from that panel as well at the Munich Security Conference. There is a lot going on in markets. Certainly yesterday was a big day for markets, if not a big day for tariffs. And today, we're looking at an S&P 500 that is showing some modest gains.
It's a little bit higher. I am interested to see how the trade develops because you think about so far the opening weeks of 2025, Fridays have been weak. People have been really cautious about holding risk into the weekend. You usually see the S&P 500 decline over the past couple weeks. Same thing too on Mondays. As we learned earlier this week, of course, it was Wednesday that was the best day. So we'll have to see what changes between now and 4 p.m. But we have to talk about Moderna. As we have been saying, we're in the never-ending earnings season, and Moderna shares, they were in free fall earlier. They've since reversed. That's after the drug maker recorded another quarterly loss, thanks in part to a canceled manufacturing contract. Sam Vazeli of Bloomberg Intelligence joins us now. And Sam, this is a really interesting story, of course, very fluid right now when you think about what's going on with shares. What's your read of what we learned this morning when it comes to Moderna and the path forward?
Yeah, I mean, look, I've been watching the share price doing what you were just referring to and being a bit at a loss, looking at the story there as to why. I mean, they've guided for 2025 before, and they've maintained the guidance. The costs are in line with what they said at the beginning. I mean, of course, nobody knows. I mean, if you look at their guidance, revenue is forecasted between $1.5 and $2.5 billion. I mean, that's $1 billion gap between the two. So, but none of that is new. And there was this thing about their norovirus vaccine maybe being halted by or at least put on hold in terms of the trial because of one case of something called Guillain-Barré syndrome. But, you know, they explained that pretty well. I don't see that as a major reason. So the volatility, honestly, I think it's a lack of understanding of all these little nuances, but nothing really new here.
All right. Well, but still fascinating, especially considering the confirmation of RFK Jr. as the U.S. Health Secretary yesterday. Sam, thanks for helping us look at one of the stocks that's moving. There are a lot of stocks moving under the surface of this market, which looks relatively unchanged. And as I said, we have gotten you a translator here so that those of you who only speak English or not, at least not Ukrainian, can understand Volodymyr Zelenskiy. Let's listen in to this panel at the Munich Security Conference.
In backstage, no. This is important for us to understand that that Europe, in fact, has been making a contribution to our fight. And on the U.S. part as well. So I already extended my gratitude to our U.S. friends, American friends, on the part of the Congress, on the part of the executive branch as well, for them to have been supporting life of our Ukrainian society. So this is what we're talking about. With regard to my encounter, my meeting with American colleagues, we have had a lot of meetings to which I'm very I'm grateful and we're very happy. We had a good talk with President Trump, where we supported this plan to invest in critical minerals in Ukraine. And I've been saying this many times, that we need to protect our resources. Why? They need to be protected because, well, let's be pragmatic. We're not talking about security only. Security of Europe is number one priority, and people and human life is a priority. But we also must be pragmatic. We're talking about protecting our resources to prevent our occupants from being able to put their hands on our resources. We need to protect our resources, and for this, so bottom line, gonna be short.
Yeah. But because it's very necessary to explain all the details. That's why I said that, yes, we have to save these minerals, and those countries, we are thankful to all the support, but those countries who will support us and who will save this, of course, they will have priority to invest in it, because we need jobs and investment, and then we will divide profits with one or another partner. So that was very important. Save it and don't give to North Korea, maybe China, I don't know whom Russia will and want to give it after occupation. We need to save it, critical minerals, and a lot of different things. That's my message. I was happy that Americans, they came, the Secretary of Treasury, he came to Ukraine directly to Kyiv. It was his first mission, and it was exactly to Kyiv. I was very thankful to him, and he brought the document, and the document was on my table. I said that our lawyers will learn it, and then with some advices or some changes, will come back. It's about investment. It's not security document. It's memorandum between two sides. And I know that I will have meeting with Vice President. I don't know. I mean this evening, but I'm here till tomorrow. I can meet evening, morning. Doesn't matter for me. Like President Trump said. So you can come when you want. I'm always in Washington. I can say to Vice President, you can come anytime. I'm here in Munich, and I'm ready. You know, really with pleasure. I'm ready to meet. I'm not ready to sign everything, but to meet, yes. I mean that I will not sign. The ministers will sign, but they will sign right memo how to save.
Якийсь меморандум, щоб добре мати справу з цими критичними мінералами, корисними копалинами. Так, шановний президент, розмова між Володимиром Путіним і президентом Трампом заохочив Путін, як ви вважаєте? Як ви бачите, це якісь риски є для США також, чи якісь риски небезпеки для США після цієї розмови? Це питання. Вони говорили по телефону. Дуже коротко. Це риски для вас?
For the US.
Risk? What is it?
Vladimir Putin and Donald Trump have spoken on the phone. You were briefed on the conversation. Is this a risk for yourself, of course, but also the U.S.?
Phone calls between Putin and Trump was risk for United States? I think not risk for United States. I think for Trump, because he's stronger than Putin. I think so. I think risks for all the world. Because the priorities, we have much more risks than risks for the United States, with all respect, for all of us, with all the big guys. And I think it's very necessary. As I said at the very beginning, I had good conversation with the President Trump. We had some phone calls, and he had phone call with Putin, and he said to me, I think that he Putin that he wants to stop the war. I said to him that he is a liar, and you can count on it. I hope that you will pressure him because I don't trust him. We had such conversations with Putin, direct conversation about ceasefire. So just ceasefire, we don't need just ceasefire. This is global problem. So we had ceasefire. It was my direct decision. And we made a decision that it will be ceasefire and exchange all the prisoners. And he didn't change all the prisoners. Yet we've been very happy. That was first step when we brought home more than 100 guys to their family. It was very necessary between us. Even because of this one reason, I had to come to France in 2019 and bring back people. But he will not just, ceasefire and that's all. That's why I said to President, yes, but I think phone calls are phone calls. Let's forget about it. I think what is very important, the meeting, not to make any decisions about Ukraine without Ukraine. This is principal position we will never accept it. And when I said that we will never accept, I'm not speaking just about me. I'm speaking about all our people, all our nation. People will not stop. We will give him pause. Without real security guarantees, we will give him pause. I don't want to, be those person in the history who helped Putin to occupy my country. I don't want it. And that's why I will never do it. I will never do it. And it's very important for me to pressure Putin, put all the sanctions. I think President Trump is ready to do it. He has all this power to do it. That's why I wanted very much to come to Washington any day this century. And to come to Washington. And I think we need very much to make the common plan of civilized people and to share all these things with our friends and with the help of our friends of Europe. It's very necessary not to lose this unity. I'm so proud that we are part of such strong Europe. And I think that it's important, very important, not to lose this unity. Before this war, maybe not too much things, by the way, which this war made positively, that unity between the United States and Europe. That's what this war brought. And Putin scared it. I think during the last 20, 25 years, I don't remember how many years he's in Kremlin. So, this is the first time when the unity could pressure him and he couldn't occupy us. Because of this unity, because of our people and soldiers, of course, but because of this, not to lose it, and now to make a deal without us or without Europe is not a good idea, and I hope that President Trump doesn't have this idea. I count on it very much. I think I answered on 10 next questions. Sorry.
I have 100 questions, but to the senators.
Yeah,
and maybe
to the senators, please.
To the senators, and maybe let's start with Senator Graham. Are you comfortable with a world in which the president seeks to do deals with authoritarian leaders like Putin or even China before consulting with longstanding allies like Germany and France?
Yeah, I'm very okay with Trump talking to Putin. He talked to him. What I'm not okay with is the world losing deterrence. Why are we in this war? Okay, they invade in 2008 Georgia. They invade in 2014. They're back at it again. So rather than worrying about who Trump is calling, why don't we talk a little bit, how the hell did this happen? I've been coming to this thing for 25 years. John McCain.
All right, Lindsey Graham, they're speaking in Munich at the Munich Security Conference. Francine Lacroix moderating that panel with some other U.S. senators, as well as Ukrainian President Volodymyr Zelenskiy, saying he's ready to talk. He's in Munich. J.D. Vance is in Munich, and he will talk to him anytime, morning or night, he says. And that is a big change from where we were this time last year. Certainly that was a big change from where we were at the end of last year.
Absolutely. And you think about some of the headlines that we got from Zelensky just now, just to read some of them, saying that we need firm support from the U.S., from Trump on our side. Ukraine also needs to protect its minerals from Russia, and Ukraine does not need just a ceasefire here. So this is a quickly moving situation. And Matt, to your point, of course, a lot has changed just in the past couple months.
Those minerals are a key negotiating tool at this point, isn't it? And on top of that, this is not just about Ukraine. It's so much about Europe as well. You know, there's an article in the Financial Times overnight about just how much Europe has been left reeling. It cited multiple officials from various European countries wanting just this, for Ukraine to also step up and push the U.S. to be more involved with everybody and not alone.
Absolutely. And I mean, you think about what we heard from J.D. Vance just an hour or so ago, some very harsh words for Germany as well, which is facing its own election in just a week's time. Meanwhile, we go back to the U.S. and we go back to these markets. We're about 30 minutes into this Friday trading session. You can see a little bit of a lift on the S&P 500 right now, 90 minutes out from weaker than expected retail sales. That lift also coming through in the NASDAQ 100 and in the bond market as well, where a lot of the action has been this week. Your 10-year yield currently lower by about 5 to 6 basis points. Let's try to put everything together now with Tom Becker. He is lead portfolio manager of the BlackRock Tactical Opportunities Fund. Tom, it's great to have you with us, and we appreciate your patience here. Let's talk about what we learned this week. When it comes to the economic data, we know that inflation is still a problem. A lot of question marks about the consumer, and then you put that together with what we're seeing on earnings. A lot of idiosyncratic stories. It's very difficult to paint with a broad brush here. Where are you finding your opportunities?
Morning, Katie. Thanks for having me. Happy Valentine's Day. I think we got some interesting data today with the retail sales. Probably a give back from the Q4 strength, but also some of the disruptions I think that people are noting on the weather in the Southeast and the LA fires. We've done some analysis about how some of these shifts in climate disruptions impact both growth and inflation. And I think it's pretty important here at this juncture as people are trying to kind of discern, which way the economy's heading. I think this temporary fall off is kind of the disruption, people having a tough time getting to the stores, the fires disrupting kind of the second largest city in the U.S. We typically see a rebuild, kind of a swing back 1 to 2 quarters out. So expect some of this activity to kind of come back in the spring and summertime, particularly in LA, as you start to see some of the insurance funds flow in and rebuild activity take place. There's another element to it as well, which is kind of the increased number of these storms and disruptions. Here in California, we're seeing 20-30% rises in insurance premiums for households, for businesses. And though those aren't a big share of the CPI basket, we tend to see over time they get passed through in markups. So restaurants have to raise their prices when they get a bigger insurance bill, warehouses, office buildings. And so there's this subtle kind of undercurrent of high services ex-housing inflation that we think is being underappreciated by the market, by policymakers. It's sort of a multi-year dynamic that's happening, and we think it could keep inflation high.
Yeah, I think that this is a very significant moment because you have investors more and more keeping an eye on every piece of data, not just the macro, but also surveys like University of Michigan as well. At the end of the day, between what you're seeing across data and what you're seeing from the earnings reports from these companies as well, how important is the U.S. consumer to hold up the market at this juncture, especially because at the end of last year, you did see a consumer trade really come back into the S&P 500 and be a big part of what broadened that trade out?
Yeah, great question. I think the consumer is going to be the anchor of kind of consumption in the U.S. economy, just the math of how, big a part the U.S. consumer is. We think when you look at the payrolls data earlier this month, you're seeing very strong wage gains. You're still seeing kind of a very strong run rate of employment growth. That's putting money in consumers' pockets. We're seeing signs that consumers, spent a lot of money on durable goods in Q4. That's usually a positive sign. And so overall, we see kind of the U.S. consumer acting as though they've acclimated to kind of this high nominal activity. They're spending kind of the savings rate's pretty low. They're spending out of their income. And we expect the consumer to remain resilient.
Tom, I want to talk specifically about the fund you manage, specifically the BlackRock Tactical Opportunities Fund. I see tactical and I get excited because that implies that, you're opportunistic here. And I see in your notes that you recently added to your short 30-year Treasury positions. And we know that the long end of the Treasury curve has been all over the place, specifically, too, in this last week, currently to the downside when it comes to yields. Talk us through that position. What is the base case when it comes to the long end of the Treasury curve?
Sure, Katie. So tactical for us is kind of the 1 to 2 quarter horizon. On that short, long end, I think what we've seen at the beginning here of the new administration is a desire to kind of keep the status quo on how many treasuries are being issued. So we had the QRA last week, Treasury Secretary Basak kind of, taking Yellen's playbook and extending it. No expectation of increased supply of long-run treasuries. We think as we get into the coming quarters, some of the fiscal policy that's likely to come out of the administration in terms of TCJA, as well as additional tax cuts, that's going to put pressure for additional supply into the Treasury market. There's another unanticipated element, which is the balance sheet of the Fed. So expectations a couple months ago were that QT was going to cease and that the Fed would then be rolling the balance sheet, buying more treasuries, kind of a bigger source of demand for that market. They released a paper at the end of last month indicating that they think they have a lot more runway. Some of the speeches by some of the influential policymakers like Lori Logan have pointed to the fact that they may want to shift the composition of that balance sheet. And so overall, we see kind of this underappreciated QT going for longer element, not yet really in market pricing. And add to that the strong inflation data we got this month. We think Fed cuts kind of here in the first half, that's a little bit too much of aggressive pricing.
Tom, do you mean to say that we may be in for some sort of Operation Twist again?
Reverse twist, Matt. Yeah. So they haven't done that. They've done a number of QEs, a couple QTs, and one twist. I think when you read some of the speeches recently, there's a desire to have the balance sheet look more like the overall Treasury market, whereas right now it looks like it's pretty long in duration. They're holding down the long end of the yield curve. And so reinvesting kind of into the front end where the Treasury is issuing, that would naturally kind of release some of the demand at the long end and do a bit of a reverse twist.
What do you think about gold continues to hit record highs? And we had a story on the Bloomberg terminal yesterday about a shortage of physical gold available for delivery in the U.S., really in the West. Do you look at the precious metal as a good hedge? Do you worry about the mismatch between futures and physical?
We don't invest in gold directly in the portfolio, but I think that dynamic in gold points to some uneasiness about the fiscal trajectory and how much issuance there is, kind of the unipolar moment for the U.S. dollar. We think that global investors are looking for alternatives. Gold has been one for decades and centuries. That makes sense to us that kind of as fiat currencies maybe come under a little bit of question or pressure, that people are looking for alternatives. And I think that can explain maybe some of the gold rally year to date. Well,
if you don't invest in gold, I'm not going to ask you about Bitcoin. I want to go back to the equity market, though, because following up what you're saying about potentially a reverse twist, maybe the long end gets released here, how does that translate through broadly into the equity market? We saw a lot of fears about the danger zone when it comes to 10-year yields. If we do see that release, we do see 10-year and 30-year yields go higher out at the long end. What does that mean for risk appetite in the equity market?
Yeah, I think it's a question of kind of cash flows versus multiples and discount rates. So higher long end yields, that should put pressure on multiples, and the multiples for the S&P are quite high here. You have juxtaposed that to foreign markets where central banks are more inclined to ease. They're concerned about the impact of tariffs on their economies. Their currencies have weakened. You're getting a little bit of a dynamic of tighter financial conditions in the U.S. this year and maybe a little bit looser in foreign markets. That wasn't the case last year. The Fed cut 100 basis points. It tapered QT. We think this year there might be a little bit more tension coming from the monetary side and keeping financial conditions in the U.S. a little bit tighter compared to foreign markets.
Tom, we thank you so much for your time today. Happy weekend to you. That is Tom Becker of BlackRock.
Happy Valentine's Day,
And
Tom.
Happy
Valentine's Day.
So much going on in the world. We forgot about love. And anyways, we're going to go back. Bloomberg's Francine Lacroix, remember, is moderating a panel at the Munich Security Conference with Ukraine's president and U.S. senators, including Lindsey Graham and John Cornyn. We're going to continue to monitor the panel. And in the meantime, you can follow it on Live Go on your Bloomberg terminals. And coming up next, we're going to speak with Jose Minaya. He's global head of BNY Investments and Wealth, about his new post and what he expects for markets into the year. This is Bloomberg. Now, according to BNY, markets in 2025 will be defined by competing narratives of inflation risk versus growth upside. And as we've been saying, that's according to the global head of investments and wealth, newly joined BNY. That's Jose Minaya, joining us here on set. And what a great week to talk about this dynamic, because, of course, inflation really did surprise earlier in the week. By the end of the week, you had investors shrugging off some of the pain with an eye on PCE, the Fed's preferred gauge of inflation next. How much does inflation still worry you?
You know, it's interesting. I think it's a little bit of like kind of back to the future. I think I was on a Bloomberg TV a little over a year ago when we were in Davos, and my storyline there was, hey, I think we're going to go into a soft landing. I made a bet at the time that there'd be no rate cuts. But we still be, having inflationary pressures.
Wait, what did you lose?
I lost $10 actually.
Oh,
Lost $10. I did. I bet another. I bet another CEO. But I was kind of happy to make the bet. I was in the money for a while there for the year. But the narrative there, it's not that different this year, right? I mean, you've got pro-business kind of administration. We're expecting constructive markets. Inflation is still sticky. Uncertainty is as alive as it was last year. Where
the pro-business narrative is certainly different, don't you think, from
this
time last year?
Yeah, because last year when I said soft landing, it was like, really, who are you kidding? Like, there was a lot more concern. There's a lot more optimism, right? The word, U.S. exceptionalism is kind of a trend. It's about growth today. If you think about our fiscal situation, even there, what the administration is looking for is more towards a growth mindset to try to get out of it.
So what's the bet for this year? There are investors pushing out their rate cut expectations. We're looking at now, there is one rate cut priced in as early as September. That was December, earlier just this week. Do you think one can even get in?
Again, and I'm probably in the minority here. I don't really see cuts again this year, largely because I think we're going to continue in this environment where we're going to be pushing up against inflationary pressures. The stock markets are near all-time highs. I think they're going to continue to go up throughout the year. So for that reason, I wouldn't forecast a rate cut, but I also don't think it's a big part of the narrative. Last year we talked a lot about it. A couple cuts came in, but largely that wasn't really the narrative for how the year went.
Well, that's interesting. That's the conversation we've been having this morning, especially, and for the past few weeks. Margie, Patel kicking off our show saying that it's not the Fed that's in the driver's seat. So if that's not the catalyst, what are you looking to drive the narrative and push the narrative in these markets from here?
Really, I think it's the advice we've always given our clients, right? I mean, staying invested, right? Looking for the right diversification in our portfolios. More of a solution outcomes, mindset from before. The introduction of alternatives in your portfolio. I think it's kind of steady as she goes because we're still seeing tremendous cash on the sidelines. That cash
$7 trillion worth.
Yeah, and by some estimates, it's the real liquidity in the market is a lot bigger than that as well. And I keep saying, look, that money in motion has to start coming off the sidelines. More recently, it's really come into the more kind of passive strategies, but I do think you're going to see more room for active management, especially because you're going to see more volatility, which is good for active managers.
I mean, we look at the money market funds all the time.
We do.
I've been doing this job for 25 years. Cash on the sidelines is a mantra that never gives up, right?
Yeah.
Meanwhile, we're fully invested. Retail investors, by a number of Fed surveys, are fully invested. The institutional investment is at a high. Foreign investors are, fully in this market. Where does the marginal investment dollar come from?
Well, one, I think institutional investors are fully invested. I think on the retail side, I don't think that's the case. I think there's still a lot of cash and money coming into that market. But look, it's kind of changing demographics. You're seeing what's happening on the retirement side with 401ks. You're seeing a lot of asset managers going from what was largely an institutional kind of driven client channel to have a lot more interest on the retail kind of wealth segments.
When we started this show, Sally Krawcheck came out and pointed out that boomers have $75 trillion in wealth that they're shifting right now.
Yeah, to women specifically, too.
Yeah,
a lot of it to women, yeah.
And that's probably one of the biggest wealth transfers is the shift to women. And again, you're going to have a different demographic of people who are making buying decisions with their money.
So one thing that I find interesting, whether you're talking to kind of the next generation Robin Hood crowd, or if you're talking to JP Morgan, which filed this morning for an interval fund for private credit for the first time, you are looking at more investors in the retail world on all spectrums looking at private assets. One question I have, I think this is right for your heart here, Matt. Do you see fee compression? Because if these are becoming much more widely available assets and you have hedge funds still charging 3 and 30 and then some with pass-through fees.
Pass-through fees, that big take that we had was just rage bait, yeah.
Yeah, and honestly, frankly, a lot of people worried about some of the returns coming down as some of these offerings are becoming more available, like in private credit. How do you make it more available without demanding lower fees?
Well, look, I think that's the natural order of our markets and really all things in all products, right? I think it's a good thing that things like private credit are more readily available to individuals. I think the individual today is, versus institutions, massively underallocated to alternatives from a correlation benefit perspective. But the more access there is, there's going to be fee compression. And by the way, of course, the more liquid a private asset class becomes, correlations come under. But we've seen this through other asset classes. Think about real estate, right? Mm-hmm. Once upon a time, you owned a building because you needed to put people in it, right? I think today, just about anybody can go to a broker and get exposure to real estate. Guess what? Those fees for managing real estate have come down. The correlation benefits of them on a public side have also kind of, changed. But it's just a nitro cycle. But we're still early in the democratization of alternatives.
Right, so that timeline is important there when it comes to that fee pressure. I do want to go back to what you were saying, though, about cash on the sidelines, because it really feels like for those active managers that you speak about, that is the most urgent question. How do you get people out of cash? And Jose, if we're in a year where maybe the Fed doesn't cut at all, there's some talk about a rate hike, we don't need to go there, but if rates don't come down at all, what is the impetus to come out of cash when I can still get 4% in a money market?
Now, look, it's a very good point, because cash today it's actually a good investment and has been. Yet look at the market returns, right, over time. Would you have been better staying in cash or being invested in the markets? I think you would have been better investing in the markets. And I think we manage a pretty large wealth business. That is why having advice for people is important, because you could sit there and go, gee, 4% cash rates or even 5% cash yield at one point seemed pretty attractive, especially from a risk return perspective. Yet the markets outpace that, right? Mm-hmm. So today, if you were that individual who were invested, the markets moved away from you. That is a loss of buying power that you have. And you're already coupling that with what is a massive retirement crisis in this country. Look, I think these are the kind of things that are really important to get the advice to people that say, look, getting invested is where you're going to be better off in the long term.
A retirement crisis, not something we talk about enough here. We do have to leave it there. Jose, we thank you so much for joining us here on set. That is Jose Minaya of BNY. And you can catch more interviews like these at Bloomberg Invest, live in New York on March 4th and 5th. It is finally just around the corner. Get a front row seats to conversations with Carlyle CEO Harvey Schwartz, Soros CEO Don Fitzpatrick, Bridgewater CEO Nir Bardea. Register your interest to attend at bloomberglive.com/invest. Plus, we sat down with Purnima Puri of HPS Investment Partners and asked her what she thought the next big risk is to markets. You can see interviews of Bloomberg's next big risk on Bloomberg Terminal and on Bloomberg.com.
There's a lot of risks that people know about, which are deficit-related, debt to GDP related. I think underappreciated risks are related to growth, and within growth, could we have a labor shortage? That's what I'm worried about.
get a look now at high interest, what's making headlines around the world. TikTok is available again to download in the U.S. after Apple and Google restored it to their app stores. The decision follows a letter from U.S. Attorney General Pam Bondi saying that a TikTok ban would not be immediately enforced. There's still no guarantee that it will survive in the long run, but of course Trump ordered a 75-day review period after his inauguration. People are still buying Birkin bags. Hermes sales surged as wealthy shoppers splurged on their handbags over the holiday season. Sales exceeded expectations, jumping 18% in the fourth quarter. Hermes outperformed its peers like LVMH and Gucci owner Kering as it retained strong pricing power and demand among the wealthiest consumers. And Starbucks is set to open 500 stores in the Middle East in the next 5 years. The chain is looking to bounce back after challenging conditions and consumer boycotts. The new CEO, Brian Niccol, telling Bloomberg's Jumana Bersecci about the damage to the brand caused by that activism.
The boycott and that whole information cycle, it's really unfortunate because obviously it hurts the brand, it hurts our partners in the stores. And the thing that's really disappointing about it is it's just not based on anything that's accurate or true. We've never supported any militaries.
And Starbucks has had a great start to 2025, higher by about almost 25% on a total return basis. Really interesting turnaround story there. Let's get a check on these markets, though. We're a little bit higher right now, about an hour into the U.S. session. The S&P 500, the NASDAQ 100, higher by about 0.1% to 0.2%. We're looking at some pretty healthy weekly gains on the S&P 500, up about 1.6% for the week. The NASDAQ 100 is your leader, though, up about 2.7%. Now, coming up, how will President Trump's tariffs hit the Canadian energy giant Enbridge? We'll ask the company's CEO, Greg Ebel, next. This is Bloomberg.
Enbridge is hitting an all-time high today after the Canadian energy giant maintained its guidance for the year on a total return basis, I should say. Just what kind of impact is the company bracing for as a U.S. tariff threat ramps up, if you believe that is the case? Joining us to talk about it now is Greg Ebel, Enbridge Energy CEO. Greg, thanks for coming on the program. It seems like the market is developing an immunity to these tariff threats, right? Because they keep being pushed back for studies or after negotiations. But how do you deal with as Jim Farley of Ford said, the cost and chaos of it?
Yeah, Matt, look, I think you have to try to focus on the long term. Energy infrastructure isn't built overnight, and it definitely is there for 75 or 100 years, and that's what Enbridge has been doing. So there is a super interconnectivity between particularly the United States and Canada, and obviously all the states and provinces. The energy's got to flow. We go by 90% on the liquid side of refineries in North America. We move 20% of the natural gas. So focus on those long-term fundamentals. We need more energy, and we need more all kinds of energy. And if you're a deliverer of energy, we like to say we're a bit like the FedEx or UPS of the energy sector. We'll pick it up and drop it off. You can't get too carried away with short-term gyrations between countries. We don't want to see tariffs. I don't think that's without a doubt, but we don't see that impacting our business definitely in the near time. You'd need some really sustained changes to make different trade pattern go away. So that serves us. That's why, we've hit our guidance for 19 years in a row and increased the dividend for 30 years in a row.
And you're seeing that in the shares. So you're not super worried about the threat of tariffs right now, but are you making any decisions to tariff-proof some of your businesses? I think about there's this talk about new pipelines maybe to Canada's coast to shield from some of the impact. I know that at one point you had a project called Northern Gateway that was canceled, right. But have you thought about bringing some of those efforts back?
Yeah, for sure. I would say we're more focused on quick hit, low multiple builds, great returning projects. permitting light. As you point out, Northern Gateway was a project that unfortunately the Canadian government canceled. I'm sure they regret that. But it would be very difficult to bring that project back without looking at those types of things with big legislative change that show projects like that are of the national interest. What we are making sure we do is make sure that our supply chains, we're often the biggest buyer of products, contracts. So, we have a renewable business. So making sure that when we buy solar panels, for example, that the seller of those solar panels to us, that they're on the hook for those tariffs, both known and unknown. So you do a lot of things on supply chains. You go to where permitting can be done quickly. As you might recall, we bought $14 billion of new gas distribution companies in the United States in the last 18 months. Those have been wonderful to have because gas generation, gas utilization is going to be big. So, yeah, you want to make sure you're in the most number of jurisdictions with great distribution of businesses so that you can take these, shall we call them hiccups as they happen on the economic front and show that type of resiliency.
Greg, I'm almost sorry to ask you so much about tariffs, but I'm sure your investors are as well. In your earnings call, you mentioned that refiners and oil producers would share a tariff burden. There has been a lot of question around this on how those tariffs might hit back on American oil companies as well. Could you provide some more specificity? If you see more significant tariffs that would really impact the energy sector here, what exactly is there about the burden to be shared, and how would that create a ripple effect?
Well, yeah, look, I think if there were tariffs over a sustained period of time, everybody's going to take a little bit of nick, right? The consumer would, producers would, refiners would along the way. But yeah, look, you're picking up a product in one location and delivering it to another location. But again, I think it would take a very sustained period of time with significant tariffs for that to flow through in a material way to anybody on the energy front. And remember, even the discussion of energy tariffs that was on the table and is on the table, I guess, was in the 10% range, which is different than what we've seen in some other products that were more like 25%. But look, a change in prices, everybody, good old economics classes, everybody seeks rents and everybody wants the other person to play. So in the end, if they came in on a sustained basis, I think everybody probably pays for it a little bit.
Greg, step back and give us a bigger picture look at what you expect to happen in the U.S. or North American energy ecosystem. A lot of talk about nuclear, but obviously that's incredibly expensive and takes at least a decade, I've been hearing, to bring on. There's renewed talk about coal again in this administration, but obviously gas, LNG, oil are still kind of the hottest topics. How does the mix look to you, say, in 4 years?
Yeah, well, look, I think, Matt, where we're going is, and we tried to structure the company looking at this from a fundamentals perspective, it is all of the above now. As you look at data centers, you look reindustrialization, you look at economic growth, you are going to need all of these forms, right? You're even hearing about a slowdown in some of the coal facilities that produce electricity, maybe running out a little bit longer time. Obviously, natural gas, we're building or have secured 5 gigawatts of new natural gas infrastructure for generation just in less than the last year. You're seeing new solar projects come in. We've just signed contracts with the likes of AT&T and Amazon. That's going to continue to be the case. And yes, nukes, but they all have their place and they all have different time frames. Probably the quickest is small gas-fired generation, with nukes probably being the longest to be able to do that, and everybody else in between. So what we see is an increased demand for electricity and energy throughout North America, and an all of the above strategy is what you really want to have, both from an economic perspective as a government, but also from a company perspective, either as a provider or as a user.
Well, when it comes to that demand for electricity, let's talk a little bit more about data centers, because this was a topic on your earnings call as well. Basically, what are the conversations that you're having with those data center operators? How much does Enbridge stand to benefit from that?
Yeah, big time. As I said, we've got a BCF of new pipeline infrastructure, so 1 billion cubic feet of increased demand from data centers and power. So you're seeing two groups. you're seeing the likes of the Amazons and the AT&Ts who might want to actually sign up for, say, solar projects in Texas or Ohio, which we've just done with them. But they also want to have natural gas backup. You're seeing the likes of Duke Energy bring on new gas-fired generation, or the Tennessee Valley Authority, TVA, moving from coal to gas, all to serve things like data centers. So there's two places. One, right in the backyard of the data center itself, or two, big utility producers and sometimes independent power producers who are connecting to those data centers. We get the benefit of both, having solar business as well as having actually electricity business, or sorry, the pipeline business as well. So yeah, it's on. I don't think it's going away anytime soon. You're going to see much bigger need for gas demand than we've seen for decades, as well as on the electricity front as well.
Right, to that front, there's data centers, of course, as we've been talking about, huge theme in the market right now, but also it's just cold. I mean, I don't know if you guys knew this.
It's always that way in the winter.
Well,
you know, when I was a kid, it was this way all the time in winters.
There's a
it
huge
would snow a
storm
lot.
about to come into next week, into the central U.S., into Texas even, and you are seeing natural gas prices spiking pretty significantly on the heels of that. Greg, where do you see prices going? Because there's kind of those near-term weather pressures, as Matt says it is winter, but also just over the longer term here, given that you have added demands outside of just consumer needs.
Right, but no, the two things. One, you're right, and it's been a cold start to the winter, colder than we saw in the last couple of years. So that's good for our business. But look, I think gas is going to stay in that $3 to $5 per 1,000 cubic feet range. Like that is a sweet spot. And you might recall, we only have to go back, 8-10 years where gas was $5 or $7 for that same unit. So we have an unbelievable wealth of natural gas in North America, in the United States, and in Canada. And even with the LNG exports, you're seeing a real price advantage for North American consumers, North American businesses, and obviously the energy infrastructure companies. So I actually think we're in that sweet spot of, call it $3 to $5. And, I think it's tough to get to $5 on a sustained basis, but that $3 world that we're in, I think, is more the logical place. And that is the Goldilocks side of things for gas usage.
Greg, we thank you, of course, so much for joining us today. That is Greg Ebel of Enbridge. Now let's get a look at stocks moving this hour. Of course, a lot moving under the market. Airbnb now up more than 15%. There's an upbeat forecast for the first 3 months of 2025, citing strong demand after a busy holiday travel season. And guys, I mean, it's such an interesting thing to see a consumer-focused stock generally up so much. Of course, we had those retail sales this morning, maybe impacted by other factors. But of course, shaken off in the likes of Airbnb and DraftKings, certainly up more than 12, almost 13% as the market opens.
Yeah, well, we know that people have been paying up for experiences, and I think travel fits into that, as we've seen, and Airbnb is a good example today.
I prefer things to experiences.
Yeah, well, you're not a millennial. Sad to say.
That is very true.
Gratification.
Yeah. That is very true.
All right, coming up, we're going to do even more on the energy industry. We'll take a look at how technology is helping oil and gas companies prevent methane leaks. That's next in today's Wall Street Week. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And methane leaks are a big problem for oil and gas producers such as Enbridge. It's a toxic greenhouse gas that's 80% more potent than carbon dioxide. And detecting leaks can help energy companies become more efficient. Wall Street Week's David Weston has the story.
So here you see a retractable tower, and at the top of the tower is a laser spectrometer.
Caroline Alden is co-founder and chief scientist of Longpath Technologies, a tech startup with a new way of detecting those methane leaks with laser-based sensors. Here in the Wyoming sagebrush steppe, near the foothills of the Wind River Mountains, pronghorn antelope and wild horses roam above one of the largest natural gas reserves in the United States. And the Jonah Field has become a proving ground for cutting-edge technology.
So the laser is going around collecting all its concentration data right up there in that little tiny box. And inside that box is a laser, a detector, and all the computing that you need to crunch the numbers on emissions from any of the well sites you can see around here. This is a kind of a fun place to be as a climate scientist because it's a place we can all kind of row in the same direction. The industry also, doesn't want to have methane emissions. This is their product that we're keeping in the pipeline for them when we catch leaks. And so it's a real win-win where if we can give them data to help them make their operations better while also reducing emissions, that's a win-win for the climate and the industry.
In 2022, the U.S. emitted around 6 billion metric tons of greenhouse gases. Methane made up about 11% of that, but it's a particularly potent and toxic gas.
Methane as a molecule is interesting because compared to CO2, which is the greenhouse gas folks are most familiar with, it's about 80 times more powerful in terms of the warming potential on a molecule per molecule basis.
Its potency makes the market for methane detection technology that much more important. And JP Morgan projects it will be more than $900 million by 2025, with a potential global market as high as $14.9 billion.
I believe this is really going to fundamentally change how operators view leak detection and repair. And I think it will change how regulators view leak detection and repair.
Howard Dieter, Jonah Energy's vice president in charge of environmental health and safety, says his goal is 24/7 monitoring using Longpath's continuous laser system, and then following up using optical gas imaging cameras and validating those measurements with drones, aircraft, and satellites.
I do think that as this technology becomes better, as it becomes more affordable to deploy, that it really is a game changer in how we think about operating and managing our facilities.
That was Bloomberg Wall Street Week host David Weston. You can catch the full show every Friday at 6 p.m. Eastern. This is Bloomberg. Well, JP Morgan is launching its first all-in-one multi-asset ETF. The actively managed flexible income ETF holds about 75% equity, 25% fixed income. It launches at an interesting time where the positive correlation between stocks and bonds has still really expressed and pronounced. So it's kind of blunted that case for those diversified funds. Let's bring in James Seyffert. He's Bloomberg Intelligence ETF analyst. Maybe he can make sense of it. So an interesting time to launch. It seems like ETF investors, they love equity ETFs. They love fixed income ETFs. But when you put them together, there's not a ton of demand, James.
Yeah, I mean, you can look at this category. We call it on the terminal the mixed allocation category. I mean, there's less than $30 billion there. I mean, that's not to say $30 billion is like something to sneeze at.
That's
but
less
I mean,
than
compared,
one IBIT.
Yeah, exactly. I mean, that's less than, many ETFs are much larger than that. And it's not just when you mix equity and fixed income together that they don't buy. Like if you look at the equity market, for the most part, allocators, they, if you take like the total stock market ETFs from the big ones from Vanguard and BlackRock, the ETFs that simply split it up do the same thing except in two ETFs. So you get the US market and then the international market. Those ETFs as a whole have basically 11 times the total of the ETF that just gives you the same thing by itself. So basically, investors like to choose, their fixed income allocation and their equity allocation. They even like to choose specific subsets within there. They may want to choose their own, how much high yield they have, how much investment grade, you name it. So these things that tend to like do everything for you all in one, they are awesome deals. But for the most part, investors and allocators, they like to basically choose where their money is going.
James, Eric Balchunas did a great piece on stock investors being bullish and bond investors being kind of nervous ninnies. That actually tracks, right? That's kind of the point of those two asset classes. But flows have been pretty amazing, especially in terms of, the records that you continue to hit, $1 trillion last year. And it looks like you're on track in ETFs, right, to do more than that, much more this year.
Yeah, I mean, right now what we're looking at is the markets it's kind of like easy comes, easy goes, right? Money is coming in for the most part on the risky side on equities, as you hinted at. But even on the fixed income side, a lot of it is going into short term. But TLT which is the 20-year Treasury, that's loaded up duration on Treasuries. Obviously, that's not credit exposure, but that's actually one of the big inflow leaders over the last week. So people are even buying duration. And what we see, like when we try to figure out what the market is doing, there's been a lot of talk. The DeepSeek model calls the crash in NVIDIA. There's all this tariff announcement, and there's a lot of stuff happening over the weekends. And in our world, we tend to look at a few different things. One, what percentage of the trading are ETFs making up? When that spikes up high, things are going bad, things are going wrong. And we look at, you could just look at the liquidity level of SPY, the S&P 500 ETF. When that thing really spikes, that means the markets as a whole are spooked. All these things that have happened so far have been rather muted, and ETF investors are just basically allocating through the storm.
But it looks like ETF investors, and your team in particular, are looking at what could go wrong. There was one particular headline from your team that caught my eye, and it was a single stock ETF could blow up at some point. It came right under the headline that Katie and I were looking at, which is that the adrenaline rush in leverage ETFs is enough to overcome the blow-up risk, but that might not be the same case for those single stock ETFs. Explain the risk.
Yeah, I mean, these things, they give you single day exposure. Most of them are 2x. So they're going to give you whatever the return of the underlying stock does, then they're going to give you 2x exposure. There are usually long versions and short versions. So at some point, if one of these 2x long versions is in a stock that goes down more than 50% in a single day, which we've seen filings for stocks that have already done that, namely like some of the quantum computing stocks, those ETFs haven't launched yet. But theoretically, if they were launched when those stocks went down 50% in a day, after Jensen Huang basically talked that quantum computer was a decade away, essentially, those things would have blown up. The thing that most people need to realize is anyone really dabbling these, as far as we can tell by the data and even anecdotes, they know they're playing with fire, they know they're playing with power tools, and they could, seriously injure themselves. But yeah, it's likely that at some point one of these is going to blow up or come very close to blowing up, because if you're 2x and you're on the daily return and it goes down more than 50% or goes up by more than 50%, one of those sides of the trade is going to blow up. The benefit is, if you're in a regular leverage and you're 2x long,
right,
you could end up owing more than you actually put in. With the ETFs, you can only lose what you put in. So there is some benefits here. And this is a really small part of the ETF ecosystem. But there are outsized risks, and it's likely, or even, I won't say likely, but it's distinctly possible that we see a blow up this year.
Distinctly possible. Let's talk about what that looks like in practice. We have about a minute left with you, because you talk about how these are a small part of the ETF ecosystem. The reason people get worried about blow-ups is because they're thinking about those inverse VIX products in 2018, which really had systemic effects on the broader market landscape. It sounds like what you're saying is if we saw a blow-up, it would be kind of concentrated to the product itself.
Yeah, I mean, obviously the underlying stock would be impacted if there's massive flows or things going on. We see that with some of these ETFs. Like, it's undoubted, it's very likely true that the 2x inverse and long ETFs, when they get to significant levels of assets, there could be a little bit of the tail wagging the dog happening, particularly something like MicroStrategy, for example. It's a relatively small stock compared to something like NVIDIA. So it would be concentrated in basically the stockholders of those ETFs. But what could it look like? Who knows? But at the end of the day, those things would blow up. They dissipate. And honestly, what moves those ETFs is the underlying stock price. So it's what's happening in the underlying stock that's going to affect these ETFs, which are built on tops of swaps and derivatives, not actually usually holding the underlying stock.
Well, we look forward to speaking to you when we do get that blow up. That is James Seyffert of Bloomberg Intelligence. And tune into ETF IQ next Wednesday at 12 p.m. Eastern. You can also read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter. Happy Valentine's Day, you guys.
Happy Valentine's Day to you, too.
It was a lovely one. The S&P snapped 2 weeks of losses, so it ended on a high note.
Well, we could see the S&P still today hit a new all-time high. We're not too far away from that. We're off for President's Day. Our guest lineup in the week ahead, though, is pretty hot. This is Bloomberg.